Tomorrow we get the highly anticipated PCE report, the Fed's preferred gauge of inflation, and that will either make or break this market. With a huge gap below in the S&P 500, but the market pretty much sitting at all-time highs. There's a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks in the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. Guys, a very mixed day in the market. We saw United Health down 3% on some antitrust news. The governments get involved, and that led flows of the bigger healthcare names lower. Look at Lilly, AbbVie, some of these other names. The bigger names in tech, Apple, Google, Meta, they led to the downside. Kind of flat day for Amazon, I guess. Same with Microsoft. Semiconductors, if this was any other sector, you would say they got hammered, but I guess you could just call it an average down day for semiconductors. But all in all, financials outperformed, but the best performing sector was real estate right here. And it's very interesting. I was actually on my phone in bed last night looking at VG Properties, just going over some of the fundamentals, the business. Very interesting value proposition in this space right now, and I think that's why it's rallying. That being said, all in all, it was a very mixed day across the board. Looking at actual sectors, we can see real estate was the best performing sector by far. The worst was metals and minings. I didn't really see any major news, so I'm not really sure what's going on right there. We saw GDX, guys. What's very interesting, I think if Bitcoin keeps rallying, we might see sustained down pressure here in gold miners. But all in all, it was a very mixed day. Look at discretionary financials, industrials, sort of the cyclical at the top here, and then we had like growth names, IGV, software, technology, healthcare, comm services, semiconductors. They didn't do too well, and again, I think we're all just awaiting the PCE data, and the market is just balancing towards that data print. But let's hop on the chart. Now guys, looking at the other majors here, the S&P 500 down 0.17%, the Nasdaq down 0.54%, mid caps flat on the day, ever so slightly green. We'll give it to them though. And the RSP as well, ever so slightly green. Down in after hours though, so I guess you could call it is net negative. And then mid caps taking it on the chin, the worst performing sector here, both in the S&P 600 and the RTY. Bitcoin continues to outperform, as you can see right there. And then we had a fairly average day in the dollar, gold, oil, as well as VIX futures, a bit of volatility. Now looking at the S&P 500, we actually did put up a green bodied candle, as you can see right here, but we did finish negative on the day, so we actually did have a gap down, and this is real indecision. We had buyers come in at the bottom, sellers come in at the top. No real winners. We did see buyers come in at the double bottom right here, but you could say the same thing for the sellers at yesterday's close. So very mixed action. And again, I've been saying this all video and all week, we're just awaiting the PCE data print. There is a huge gap right here, and we can afford pullbacks all the way down here, and we can buy the dip looking for higher price action, and we can actually afford a pullback as low as this wick right here to the 49.50 area. If we pull back all the way to this upon PCE, we can actually look for buy the dip opportunities. Even if we wick below, it's fine. That doesn't really matter. Really what matters is the close, because that really does determine sentiment. But again, if we do get any form of pullback on PCE and we stay above this wick, that's bullish. That probably means we go higher. But if we do let's say gap down, or gap down, sell off on a pretty large wick below this area with a very minimal wick on both sides to here, that's a bit of a grim situation. And then at that point, that'll probably mean we do go lower and hit some lower price levels. So now what lower levels can we afford a pullback to? Let's say we get a hot PCE print and the market goes bananas. To this level right here, 49.20, I think that's one level. And then this level right here, I think these will be the two levels where in this area where we look for buy side support. But if it does get to this 48.45, we're going to have to monitor the market quite holistically, because then the pullback can really get going to the downside. But all in all, this is a market where you want to just be buying dips, looking for upside potential, because it's worked for the better part of 18 months, and why shouldn't it continue to work as long as the economy is good and earnings are as good as they are. Now we are just a couple of days from the turn of a new month, and we have some amazing stats, a perfect record right here. And this is the 12 months after December, January and February are each positive. These are the returns we can expect: 25 wins, 0 losses, average return 16%, and momentum brings momentum. I say it every single time. And the only year with a double-digit drawdown was this year right here, 2011. Other than that, drawdowns were very minimal from March to February the next year, and the draw ups were quite substantial, producing returns in excess of 16% and a 16% average. And this actually coincides with my composite cycle for March. You can see here that March on average returns just under 1%, and this is indexed to trading years in 2024. Now, moving on to earnings, guys, we had a pretty big day of earnings. What we can see here is that we had Snowflake, Salesforce, AMC, Marathon Digital, Paramount, Okta, Ionic, Duolingo, quite a lot of earnings here today, but we're going to specifically look at Snowflake and Salesforce just because I have an ETF portfolio, and this portfolio is probably like 75% tech, application software, application infrastructure, semiconductors, just in the tech space. So I like to keep track of these types of earnings. Now, let's dive into it. So Salesforce, 2.29% versus 2.26 earnings per share. Sales came in at 9.29. They actually beat on Q1 guidance, and then Q1 sales, they said, hey, we're going to get a bit of a softer sales situation. I do think that they actually did about a $10 billion dividend and share buyback program on Salesforce. So the market did like that. And I actually thought the earnings was good. The guidance was good. I just think that a lot was priced in, and that's why it was down after hours. But I think this will probably continue to run up into next quarter's earnings. You know, being down like 3 or 4% after the bell. Sometimes, especially after hours, just a bit of thin volume can take you there. But Snowflake, real rough go. You know, their CEO, Frank Slootman, is retiring. That's the new CEO, Ramaswamy. The reason why we were down 23% after hours, despite a fantastic quarter, by the way. These numbers beat on EPS, beat on sales by a lot. It was a great quarter. They executed on the quarter. It's just that this right here, product revenue was plus 22%. The market was actually expecting 28% for financial year 2024. And then this right here, this is the main one. 6% EBIT margin guidance, sharply missed by 320 basis points. So, you know, the market was expecting like what, 9.2% margins. They got 6%. That's why they got absolutely hammered down, 23.45% after the bell. And so it looks as if just off the baseline that as Snowflake begins to scale, that margin improvement during their scaling process isn't quite there just yet. So they have a lot of work to do. But hopefully this new CEO can do something. And I might actually do a bit of a deep dive into this on my Twitter. So go follow me on Twitter, guys, just because if it's down 23%, this right here might be opportunity to get in. Now, let's actually look at the economy, guys. We got the latest Fed GDP Now estimates, and we actually ticked up to 3.2% in the GDP Now figure. And this is what the consensus is. So most banks think we're probably going to get in the 1.5 to 2.5% range. According to the Atlanta Fed, we're going to get this right here. And this just shows an acceleration in the economy compared to what most other people are thinking. And that could lead to higher inflation. And that's why the inflation targets right now are sitting at 2.4% and 2.6% after inflation is predicted to rise 0.4% in January, taking annualized metrics above the Fed's target. This right here, this 2% is the Fed's target. And if we do print a 0.4% in January, we are going to look at a 6-month annualized figure of 2.4%. And if we actually print above 0.4%, and we do have to look at the rounding error because sometimes we'll print like 0.38% and they'll round it up to 0.4, and sometimes we'll print 0.41% and they'll round it down. So we have to dive into the specifics, see if it's above 0.4%. I think the market is not going to like that. And if it is below, I'm not sure how the market is going to react. But one thing I will say is that if inflation does keep rising and we move further away from the Fed's target, in aggregate, the market is not going to like that. Now, looking at inflation over the next year, the NFIB survey shows more companies are looking to raise prices, and this is going to have a tangible effect on inflation. You can see here that CPI all items and percent planning to raise average selling prices has actually been increasing quite significantly. This is going to really affect inflation if it does come to fruition. Again, this is just companies are planning to or looking to raise prices. Doesn't mean it'll actually happen, but good stats to look at nonetheless. Now let's switch gears and talk about earnings. Now this was some very interesting data right here. Everybody always talks about the concentration risk of the Magnificent Seven or the top 10 stocks in the index. It's actually very common. This right here is the share of market cap of the top 10 stocks in the topics, which has been absolutely rallying, and it's sitting at 20.5%. Now, I do know the S&P 500 is sitting at about 32%, but I'm just saying that there is concentration risk in a lot of these indexes. But that being said, in the topics, we actually see 22.6% of earnings comes from these top 10 stocks. So a lot of the time when we do have these big concentration factors, you know, these top 10, top 7 stocks making up the majority of the index, normally it is backed up by earnings. And when that's the case, it's not really really a risk factor. It's just typical market dynamics. Now, on the topic of earnings, something we're starting to see is the Russell 2000 has turned positive for the first time since September 2022. This is EPS growth for the S&P 500 and the RTY. And you can see right here in the quarter, the fourth quarter of 2023, earnings is officially positive for the RTY. Now, we did get a rally since October based on the easing of financial conditions, and the fact that this rally is now being backed up by earnings is a really, really good thing. And we should actually see that continue to accelerate in 2024 and continue with the broadening out in the market, both in mid caps, small caps, and sectors as a whole. Now let's dive into actual EPS estimates for the rest of the global market. This is very, very interesting. So guys, the EPS growth rate of Japan has beat the US and the EU after 2010. This is the Topix, S&P 500, and the Stock 600. You can see here that the Japan EPS since 2010 has outperformed the S&P 500 handily, quite handily, as well as Europe as a whole. And you want to know what's something crazy? During this time, Japan has had 2 different earthquakes, and the companies are still producing stellar earnings, beating the S&P 500. This is actually a very resilient economy when you look at it like that. Now, the Nikkei 225, Japan's main index, or the Topix, one is price weighted, one is market cap weighted. Now, the Nikkei 225 is a price weighted index, and this is a comparison against the Dow Jones. So the Dow Jones, 1919 to 1969, actually made a high right here, and then took quite a number of decades to go ahead and break this high. When it did, it saw sustained rallies, making higher highs, higher lows all the way. And we do know what happened in the Dow Jones from 1970 onward to right now. It just kept going higher. Sure, there was bumps along the way, but it did keep going higher all the way. We do know that the Japan market is backed up by earnings, and since we have actually broken this high right now, we can actually expect the Japan market to move significantly higher from these levels. I'm not going to say it's all going to happen in the next 6 months, in the next year, but over time, breaking this high should be absolutely pivotal for higher sustained price action. Although something that does worry me about the Japan market is the demographics, the amount of old people, the amount of deaths, the amount of births in their population. But that being said, with how globalized the Japan market is, we should see this to go higher, especially in the near term, talking 2, 3, 4, 5 years down the line. Now, switching gears, talking about buybacks, this is very interesting. Global corporate buyback announcements from Jan 5th to February 15th is actually tracking the highest since 2021 and 2020. Now, we do know that a bunch of money came in right here, and we've had negative earnings for 2022 and most of 2023. And the fact that we are ticking up is actually a really, really good thing. And I actually do expect this to accelerate simply because corporations holding cash is at an all-time high. Corporations love the fact that they're getting 4 to 5% in yields, and eventually they're going to put this cash to work. And I think one way they're going to do that is through buybacks, especially if management teams do realize and look ahead and say, hey, earnings are going to be really, really good. Based on earnings growth, our stock is looking quite cheap right now. So hopefully we do see a lot of this cash rotate into buybacks, maybe dividends as well. That'd be really good. Acquisitions, M&A, again, that'd be really, really great to see continued growth and sustained growth in the S&P 500 in the market as a whole. Now let's actually have a look at what hedge funds and fund managers are doing in the past week. Now we can see that in total, there was actually a huge inflow into equities led by comm services, ETFs as a whole. And then we had consumer discretionary, financials, materials, utilities, real estate, healthcare, staples and industrials, energy as well. Didn't really do much of nothing. Some had outflows, some had inflows. However, technology, despite Nvidia's earnings, saw a massive amount of outflows. And maybe hedge funds are looking at this and saying, hey, things are getting a bit ahead of itself. This continuation in tech is not going to continue. We are just going to consolidate. And maybe they want to buy other sectors that do look cheap, like comm services, like financials, like materials, like consumer discretionary. And this just supports a broadening out nature of the market. However, this could also be fund managers and hedge funds hedging ahead of the PCE print. Maybe they just don't want to hold technology and they prefer to hold stuff like comm services, which has a lot of like telecoms, which is a defensive sector. We also saw a big rotation into utilities, like we saw on Tuesday. Maybe funds are looking at stuff like quality in comm services and present cash flow opportunities versus future cash flows opportunities in technology. And maybe funds are just overweight tech because it's run up so much and they're just decreasing their overall book in technology. It could be a whole range of things. We have to see how this plays out over the next couple of weeks. Now, guys, looking at consumer sentiment, yesterday we got the conference board consumer numbers, consumer confidence numbers, and it actually ticked down ever so slightly. At the same time, we also saw your present situation and the expectations index. And this just measures the consumer's assessment of current and future business conditions, and both fell in February along with consumer sentiment. And this just pretty much means that consumers are more pessimistic about the short-term business conditions outlook in February. And we can actually see at the same time, we saw the perceived likelihood of a US recession over the next 12 months. This actually had an uptick from January into February after going on a pretty strong decline since May 2023. And so consumers as a whole are just more pessimistic about short-term business conditions. And we'll see if this is just a bump in the road or if this will be a sustained trend as we do get hotter inflation numbers, if we do get hotter inflation numbers following PPI and CPI from last week in this week's PCE print. Now, we actually might see higher inflation as traders are betting on substantially stickier inflation in the US. You can see here that the break-even rate on the 2-year note is currently at 2.7478%, the highest in almost a year, guys. That's crazy. And essentially traders are betting on the fact that inflation is pretty much going to be at around about the 2.75%, give or take a tiny bit over the next couple of years. And just for the record, a great way to hedge against inflation risk is through staples, stocks that deal with commodities like energy, metals, mining, and materials. So if we do get, sustained amounts of inflation or stickier inflation, it's good to hold stocks in these sectors. I particularly like energy just because it's a bit cheap, but I think the commodity sector as a whole is trading at a pretty deep discount relative to the market as a whole. Now, let's actually talk about market breadth. This is very, very interesting stuff. I'm so glad I got a hold of this data. Now, we could see that this is the S&P 1500. So it's large caps, mid caps, small caps, advancing and declining dashboard. And generally speaking, when you see a bunch of these greens, right, it's just stocks advancing on the day. And you can see that a ton of stocks are advancing on the day. Very few stocks are actually declining. If you want to see a sustained downtrend, you want to see this type of red price action, this type of red price action, this type of red price action all throughout these charts. Until you get that, we're not actually going to move lower. For indices to move lower, stocks need to move lower. That's simply how it works. And stocks aren't moving lower. More stocks are always advancing than declining. Now let's talk seasonality. Now guys, looking at Gamma 5100 is the call gamma resistance right now, and the gamma flip zone is sitting right on 5,000. So this is moving up as the market is not really doing anything else. And I do think that based on how big this gamma strike is, we're probably not going to move to the 5200 strike anytime soon, but we're also not going to move down anytime soon. Something to note, see this right here, all this negative gamma building higher up the tape. That's a bit concerning. That's a bit of risk coming into the market. It's a bit of the bears getting a bit ballsy, saying, hey, this market's looking a bit weak, looking a bit exhausted at the top. We're going to start putting in positions right here, and that's exactly why we're seeing the gamma flip zone move higher and higher into the tape. And it's also why we're seeing this 5100 strike not move higher, because there's a lot of negative gamma coming into the tape here as well. So just something very interesting, some interesting developments happening right there, guys. We are going to be exiting the window of weakness in the next couple of days, so do take note of that. But we are still in positive gamma, and it's buy dips, sell rips until we probably get below this 5,000 mark, and maybe even some lower levels below that. On the technical charts, we can actually move a lot lower and still be in a sustained uptrend without any real technical damage on a technical basis. But on a gamma basis, on an options basis, look at 5,000, look at 4,995 as the gamma flip zone, where we do flip into negative gamma and volatility does expand. Now that doesn't mean we absolutely dump in negative gamma. It just means that dealers buy into strength and sell into weakness, versus buy dips, sell rips, where they sell into strength, buy into weakness. Now guys, this is the March seasonal composite cycle right here. So I just wanted to show you guys this. I showed you at the start of the video, but pretty much March tends to be quite a positive month all in all. We can see quite a bit of volatility here in the first week and the second week into OPEX, but generally speaking, we do make higher highs, higher lows, and we do normally average about 1% worth of gains in the March period. Now guys, looking at the Nasdaq 100, this is looking like it's showing a bit of fatigue, a bit of exhaustion, but it's not really moving to the downside as sharply as it did right here. We did go ahead and make a double top. It was a higher high double top, and until we go ahead and break this level right here, I would look at to buy all dips, but this does look a bit exhausted at the top. And if we do actually pull back to these lower levels, don't be surprised. Tech has run up quite a long way, from pretty much the 14,000 mark to the 18,000 mark. That's a huge rally here in technology, or an index heavily weighted to technology. But we are still holding for the most part. We are still holding key technical levels for the most part. looking at the Russell 2000, okay, this is looking a lot more grim. You saw the chart in Nasdaq 100, you know, but we're making higher highs and holding key levels, making higher lows. In the Russell 2000, we are doing that. You can see here a low, higher low, higher low, higher low, higher low. The problem is we can't break above this right here. Every time we get to these levels, just above the 200 mark, 204, 205, you know, we get selling pressure. The bears come in. They're very confident at this level. And you can see that happened today too, down negative 0.82%. Now, I did say in the weekend video or my video yesterday that we have to hold above the 199 level, absolute key critical support zone. So we could pull back all the way to here, hold and look for higher price action. There would be no technical damage on the chart. But we do break below this 199 area, get here to like this 196, 197 area, and then things are looking a bit grim. What's also grim is that we didn't go ahead and make a high above that high right there, as you can see. So it's actually a lower high double top, and that's not really positive. You don't really want to see that. But again, the market's awaiting PCE data. I think if PCE data comes in line tomorrow, it's going to be a nothing burger. If it's hot, I think the market's probably going to move lower. If it's a cool PCE number, that could be a bit of a different story. But yeah, a lot is going to depend on what's happening with the PCE print tomorrow. That being said, not looking too good for the Russell 2000 and has really struggled at this 200 level. Looking at the equal weight was actually positive for the day, ever so slightly. Call it flat, but they were positive. And this is looking quite bullish, but compared to the strength, you can definitely see like the strength is fading as we make these higher levels, but that tends to happen as we approach the 164 all-time high level. Once we get there, we might see, you know, strength to the upside, and we have had a super strong rally since the start of November. That being said, definitely looking stronger, and we can actually afford a pullback all the way to like this 159, 158 level right here. Look for higher price action. There's no technical damage. It can get a bit grim below that, particularly below the 155 area. This is going to be the key zone that bears want to hold for the most part, but again, we can actually afford a pullback all the way to here, all the way up. But again, if this doesn't hold, we probably do go lower. Now, data in the week ahead, guys. These are all the data points right here. Tomorrow's the big one. We get PCE as well as Michigan sentiment, construction spending, ISM, manufacturing. A big day of data tomorrow. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, guys. Like this video, leave a comment. Cheers.